Your colleagues were telling me that it's the Fridays like Friday casual dressing and all of that. I can see you in Friday mood as well.
Over the last 5 years, more than 100% of returns is because of EPS growth.
Axis Mutual Fund will remain a growth-focused fund house.
Absolutely. I want to spend a moment also in terms of this whole AI trade. Is the same issue that we saw in 2000-2001, where we saw extraordinary leverage getting built up. And then all the thing came down like a pack of cards, right? Are we there yet? I don't know. Who's going to know?
And today, the next 5 years, you tell me that in India, whether 100% of the investors will go to passives, my answer is no. On a 3-year basis, 2-year basis, even 1-year basis, multi-caps are done extremely well than flexi-caps. The differential is at least to 4-5%.
I've had a phenomenal conversation with Siva. And guess what? Forget equity funds. He's convinced me that I need to immediately run and after the show, go and do my investments in my fixed income fund.
Is it?
I'm out of the office, as you can see, heading to pick up a coffee, and as usual, I am looking for an interesting market conversation. Today, I'm about to get to the headquarters of a mutual fund house, which has been going through a very important transition in the last couple of years. There have been several changes at the management level, and there are changes in the investment framework and philosophy of the fund house as well. I'm talking about Axis Mutual Fund, the country's 8th largest asset manager. So let's head across to them and find out what's brewing and what's new. Hi, I am here to meet Mr. Gopkumar and also Mr. Sivakumar.
Yeah, Gopkumar, you have to walk straight and take a left.
Okay.
In that direction.
Okay.
And the Sivakumar, you have to walk straight and take a right.
Okay. First, I'll go down and meet him. Okay. Thank you. Hi.
Hello.
Hi, Shiva.
Welcome to Axis Asset Management.
Thank you so much for having me over. And I think I've picked an interesting day because your colleagues were telling me that it's the Fridays like Friday casual dressing and all of that. I can see you in Friday mood as well.
Yeah,
so this is good.
It's mostly jeans and t-shirts on Fridays. Yeah.
That's good. So are you in a weekend mood already?
After market close, I think.
After close. Okay, I get it. So I know you will be quite busy. The idea is just to quickly grab a cup of coffee and pick your brains for about 15-20 minutes.
Sure.
And then we'll let you get back to your desk.
Sounds good.
So if you have the time now, should we
Yes,
go along?
let's go.
Okay,
This
brilliant.
way.
So I want to start by telling viewers a little bit about R Sivakumar, who is the Chief Investment Officer at Axis Mutual Fund. Now, I remember meeting Siva way back, I think it must be 9-10 years back,
Yeah,
in
easily.
our old office, when I was still trying to understand what happens in the fixed income market, because he's been the fixed income guru for the longest time. How many years have you been,
With Axis since 2009, but as a fixed income manager since 2001.
Since 2001?
Yep.
2026, whoa, that's a long time.
Yeah.
So he's been the fixed income specialist, what's going on with RBI policy, with bond markets, with those yields, all of that. But now, of course, Chief Investment Officer, so congratulations.
Thank you.
This happened, I think, 5-6 months back?
In March this year, yes.
Oh, okay. So, what changes, what stays the same in terms of just your day and the agenda ahead for you?
See, more of the same, not too much of changes. I've been part of the Axis investment team since 2009. So for me, this is part of what I do, and I've kind of really embedded with the way we operate. So I'm also very convinced about what we do. So it's not that we want to make any radical changes to the thought process, but yes, we must adapt, change to the way the market is adapting. Market has changed over the last, let's say, 5 years post-COVID. So yes, some changes will be there, but driven by the needs of the hour, not by a change in our philosophy, which I think remains the same.
Okay, all right. So obviously, and viewers will know this, the markets have been volatile and they've been fluctuating. And also from, what I recall and whatever I've seen and read, your predecessor, Ashish. So since he, I think, came over as well, there's been a change coming over in the traditional investing ethos that the fund house was known for, right? Going for growth stocks, growth companies. And I think the debate has always been about valuation, whether you go for growth stocks and stop worrying too much about valuation because you might just miss the bus, right? Or do you have to go for growth at a reasonable price. Now, as you set the mandate and the path ahead, let me start by understanding the overarching Axis philosophy today.
Great. No, we are a growth house. Okay, so
Uh-huh.
there's no two ways around it.
Okay.
And the last 5 years, it's quite interesting. It's people say this is the value time, right? That value has outperformed in the last 5 years. So we broke down the last 10 years into two periods, both pre-COVID and post-COVID, essentially, right? COVID is roughly about 5 odd years ago. And if you look at the 5 years pre-COVID, about half of stock returns came from EPS growth, and the half by re-rating, meaning the stocks,
Multiple
multiple
re-ratings.
P ratios going up, right? So in a sense, it doesn't matter in a sense what valuation was, because valuation kept coming in your favor. The market was reasonably narrow. Growth stocks became more and more expensive, but growth did well both in terms of EPS growth as well as valuation. What's really interesting over the last 5 years is more than 100% of the returns is because of EPS growth. Let me repeat that. More than 100% of the returns because of EPS growth.
Okay.
And overall, because the multiples have generally derated,
Correct.
valuations have slightly detracted from total returns.
Okay.
This is very interesting because we think that the last 5 years has been about value. But like I said, it's markets have done well, but they have done well only because of growth. So it is not that I want to change anything about the growth style of investing.
Okay.
But because
So Axis Mutual Fund will remain a growth-focused fund house.
absolutely.
Okay.
But what has changed is that you need to pay attention to value, because when you have these valuation derating cycles and re-rating cycles, right, you cannot ignore when valuation suddenly comes into play.
Yeah,
And if, for example, if PE multiples derate over a period of time and you're sitting on expensive stocks, then effectively, even if you have growth stocks in your portfolio, you're still losing money because of valuation derating.
True.
So this blend is needed.
Okay.
That's what is called growth at reasonable price. That it's not that you're focusing on pricing or valuation alone, but rather to say that you're buying growth, but what valuation or what multiple are you willing to pay for that growth, and is there sufficient differentiated growth that justifies ever increasing multiples?
Sometimes I wonder in the Indian market whether growth at reasonable price is just a textbook phenomena. Does it really exist? Because by the time you figure out this is a growth stock, the whole market has figured it, and the valuation is already run up, right?
You're 100% right, and I think so. This is very important, which is again a phenomenon we've seen maybe post 2021-22, that what we called growth, quality, those definitions have changed. So earlier, pre-COVID especially, the number of stocks you could you could say are growth, have sufficient free cash flow, quality, sustainable growth, etc., was relatively limited.
Okay.
That has broadened. And so therefore we've had to adjust. Just to give you some numbers around this, prior to 2023, our entire stock universe used to be between 200 to 250. Today that is closer
For the fund house.
For the fund house.
Okay.
So which means all the funds, all the schemes would have to buy within that list.
Within the 250
Right.
group of stocks basket.
Today that list is about 450.
450.
So which means that the number of companies that we think actually can deliver sustainable growth has almost doubled in the last 3 years. So within that, you still need to build a portfolio.
Correct.
So then these are the companies which we think have some sustainability, some growth. And so how do you pick? So yes, you still want to pick the faster growing companies within that. But now it allows us to choice of, can we pick growth at a reasonable price? Because we have a fairer choice or a wider choice for fund managers to pick from.
Sure.
So that's approach.
So this expansion in terms of just the number of companies that Axis funds are investing in now, the expansion, I'm guessing, has happened more on the mid and small cap side. I mean, as you've expanded that universe, where have you looked?
So I think it's across the space really.
Okay.
We've had quite a few companies which, for example, in sectors which were like hard assets, infrastructure, capital goods, which pre-COVID for 5 years, 10 years struggled to deliver sufficient returns. This can even include large cap companies, which really struggled with being able to deliver corporate profit performance or cash flow performance. But so yes, the one big delta is in the mid cap, small cap, the number of IPOs, All that has contributed to the increase in the number of stocks.
Hmm.
But even within the established large cap traditional sort of names, which there also we've expanded. Probably, obviously not to the same extent, but certainly some expansion on account of that as well.
Because you have your task cut out, and I'm sure you already know that much better than anyone else, right? Because while of course everybody knows the pedigree, everybody knows the potential, I think investors have been waiting for Axis to get back to the top of the league tables as well. And you know, so you look at the performance, and then people complain about, okay, maybe the large cap funds or maybe the flexi cap funds haven't done as well as some others.
I think,
so what do you say to that? And what's the journey ahead?
22-23 was very difficult for us because of this inflection. That
this widening of the universe. Okay.
And so it has taken us maybe a little bit of time to expand that universe. That was one miss for us, certainly. The second challenge has been that, like I said, on valuation, right?
Yeah.
There were so many companies which were showing growth, which were available at significant lower multiples than perhaps the companies were in.
Then the very high 80 PE multiple companies, and then
so a mix of both, right? We have reacted, we have changed, we've changed the portfolios, we've changed our methodology, and today I think the portfolios reflect that those changes. I'm very encouraged by the recent performance of most of our funds over the last 1 or 2 years, where we've really got back some of our mojo in terms of being able to sort of build those portfolios. But yes, we still have to sort of make up for 22-23.
Curious question, and by the way, this is like a really lovely space. I love your cafeterias, lots of open light.
Would you like to pick up a cup of coffee? That's
let's do that.
Theme of the session is. So
most definitely, get something to drink. So I'm just saying that something which strikes me, and I've been asking you all about equity funds, right? Because as investors, and this is a market which is so focused on equity, you've been a fixed income guy largely. So now, as you look at everything from 35,000 35,000 feet above ground, how is it an added advantage that you've had the fixed income experience? So you're not too, I don't know, emotions don't get in the way in terms of making the right decisions, in terms of steering the ship. How is it?
Over my career, I think I've done everything. I started as an equities analyst.
Oh, I didn't know that.
Okay. Yes.
Okay.
Spent about 2-3 years doing that.
Okay.
Then ran fixed income. I've done global portfolios, structured products. I don't think there is any part of investments in Indian asset management that I've left behind. So I think it does put me, hopefully, in a position where I can look at all of these assets
more
a little bit objectively and
from up there.
I think India fixed income has been very difficult, especially post 2023, as the tax advantages were withdrawn. It's not to say that it's tax disadvantaged, but essentially marginal rate of tax on everything you buy in fixed income, whether you buy directly bonds or fixed deposits or you buy mutual funds. Now what that means is that investors have really not looked at mutual funds to give sort of fixed income returns.
Correct.
Interestingly enough, we've done some studies which show that debt mutual funds have pre-tax outperformed other traditional savings instruments, fixed rate savings instruments.
Pre-tax.
Okay. So therefore, it makes sense to do it pre-tax. And therefore, on a post-tax basis, because now tax is neutral, you're actually still better off buying, let's say, a short-term debt fund than an equivalent shorter duration deposit, for example.
Really?
Yep.
Wow. Okay, this is the headline for me, because a lot of us investors, we don't think of it that way. We think, okay, why bother with fixed income funds? Tax ka fayda to hai nahi, since the tax changes happened in 2023. But Siva is saying that in today's day and age, because traditional savings instruments and fixed income funds, they have the same tax treatment. You're saying there are debt funds which can actually deliver better returns? And I'm not talking hybrid. You're saying pure debt funds?
Pure debt funds.
Wow.
And there are strategies around.
Why didn't I meet you earlier?
Let's pick up our. That's.
I think we'll go back
that
there.
side.
Yeah.
So the way I see it is that you can also use debt funds to optimize your post-tax. Give you a simple example, right? We say that investors should have higher debt allocation the closer they are to retirement, right? That's a typical asset allocation model. But
Do
then
you
you
believe
say,
in that, by the way?
we'll talk about that. I do have thoughts. uh,
Yeah.
maybe we can take that before we go to the other point.
Yeah.
So I ended up meeting certain clients a few years ago, and in the context of a bank sort of an event, and there was all this discussion about asset allocation and there is typically that 100 minus age.
Yeah. The older you get,
the older you
lesser the
get,
equities, and you
so
have
on.
to be on fixed income and
So
all that. Yeah.
I had a very simple question that I asked this gentleman. I said, "Whose age?" Okay.
Investor's age, right?
No,
It's
because
traditional
is it
wisdom.
for that? So this gentleman, I said,
Yeah.
who is the saving for? Is it for you, or are you leaving it as a legacy for your grandchild?
Okay.
Because if that money is for your grandchild, then
Then
it is
it can't
100.
go on fixed
No,
income.
it is 100 minus grandchild's age,
Oh,
right?
that's true.
So
Yeah.
it's very tempting to just say, follow a heuristic and say 100 minus age, or come up with any asset allocation philosophy. But have a thought process in mind that the time frame for you may be very different depending on what that pool of money is for. If it is the pool of money which is for you, certainly have a higher fixed income allocation. But if you're leaving that behind for your children or grandchildren, it has very, very different take. So I think, and very often in the way we look at asset allocation, wealth management, we don't pay enough attention to dividing your wealth into these buckets. How much is for me, how much is like an emergency fund, how much am I keeping for, let's say, a trip of a lifetime. I'm going to go and spend a month in Antarctica, or whatever it is that you want to do, or what, anything else, or how much, some people dream of going to Mars. That's a different story.
How do you budget for that? How do you plan for that? Maybe a separate conversation.
It's a separate
on
conversation for
how
another
to
day.
budget and invest for a trip to Mars.
But the point I'm trying to make is that, so we're going back to the earlier conversation about retirement. So imagine that you're today salaried, you're in a tax bracket which is 30% plus, surcharge plus whatever, so you're 30 to 40% tax rate. So you say, I don't want to buy fixed income. But if you buy the growth plan of a debt fund, remember that you only pay the tax when you actually redeem.
When you're actually taking the money.
Right,
out.
take the money.
Yes.
So today, you may be in a high tax bracket, but post-retirement, you may not be in the same tax bracket.
I never thought of that.
So you save during your sort of pre-retirement years.
Oh no.
Redeem.
I'm time out on this conversation. Wait, I need to go back to my bank and change a couple of things. No, joking.
So,
but this is wait, let me reiterate that for people who are watching. This is epiphany. I've just met Siva, and it's so true, because most of us think of debt funds as something which is not that tax efficient anymore, and we leave that money either in our bank fixed deposits or in our traditional savings. And we keep paying tax on that, because every year, whether you are removing that FD or not, whatever interest you're earning, you're paying tax on that. And if you're at 30% tax bracket, you're paying 30%. But you're so right that debt fund will help me defer the tax, which I knew, but I didn't think about it. If I'm going to withdraw it after 60, and if I don't have income, I'm not at 30%.
Yes. So then you only pay the tax at the tax rate that you are liable to.
What am I doing in life? Okay, continue.
So this is an advantage which people are not taking advantage. This is. I think people are underestimating how debt funds can help.
But it's also, Siva, a function of some of the casualties that we've had along the way, right? We've had fixed income accidents.
Back in 2018-19, that's now getting closer to the 10th anniversary than anything else.
But the fact that fixed income is not really fixed, it's not the same as, my money will always be like that. It can go through its ups and downs, right?
So you are taking risk, right? You don't come to a mutual fund because you want 100% safety. And for that, bank deposits exist, right? So you have much more safer options out there. But if you're willing to take some market risk, and fixed income also has some market risk, much lower than equity, but it does have market risk. It has volatility risk, it has credit risk, but these risks are well disclosed, well understood, and therefore if you go down that route, I think investors are missing a huge opportunity in fixed income. Now, of course, most investors...
You've converted one today, right away.
Most investors choose to play fixed income through hybrid funds. You're welcome to do that. I think that's a better tax advantage way for many investors to do it. But please look at fixed income a little strategically and say that, a portion of my money, I'm going to just keep it away. I'm going to move it. Anyway, I'm going to withdraw this after the age of 60.
So, okay, now to complete, since we are on this very exciting topic, and trust Siva to make debt more interesting than equities, who better, than him to be having this conversation with. But since we're discussing this, right now for someone who is looking at pure debt funds, which are the categories? And again, this is not someone who needs the money maybe in 3 years, 5 years, and also someone who doesn't need it for the next, say, 10,
Right.
15 years to retirement. What categories are relatively safer? You have a
Yeah.
peaceful night's sleep as well.
So broadly, we've looked at three types of investors who are looking for fixed income, right? So one is someone who just needs it for liquidity. So obviously you have your liquid overnight kind of funds which satisfy that need, and then someone who needs, ultimate in safety, but short term, short duration. I don't want any volatility. So then that's a second pack. There are a lot of money market shorter duration funds, and then you have investors who are really looking for something extra. So how do you get that extra returns?
Yeah.
And today that's available in many mutual funds, but I think alternate investment funds, etc., have started to come into that space. So depending on where your risk profile lies. But first decide exactly where you want to be. Do you want to be in that ultra safe? I want to keep this practically as safe as or close to cash as possible. Do I want to keep this for like a 1 year, 2 year intermediate term, or do I really want to make some excess return with taking some amount of risk? I think mutual fund categories are well defined now. SEBI has all of these categories made out, so you can just say, okay, I can pick up a category which is closest to the risk that I want to run,
Okay.
and that's the way to do it. I think there's much less variability and there's much less risk compared to equity. You really can't go too wrong in this.
All right. Very interesting. Fixed income conversation, and definitely plenty of food for thought. Now, what I want to get to is something that Siva spoke about when he was in our office. We were doing a personal finance show together. And I must tell viewers about this. I still remember because Siva said to me, and we were having a conversation offline just like that. And he said, Surabhi, let's not get too gloomy on this market because I see signs in the current environment here in India and in the Indian market, which are very similar to 2004, right? 2004, 4.
2003, yep.
And that was the time, it was just before the mother of all bull runs began in the Indian equity market. I remember in my 20 plus years of tracking the market, that's the biggest bull run that I've seen. But what made you say that? And tell us more about this parallel 2003 and 2026.
The parallels to 2003 are fantastic.
Okay.
So I'm going to start from the top and we'll work our way down. Okay. So macroeconomy, GDP growth last year, financial year 26, we clocked less than 9% nominal, right? Not real growth, nominal growth, because we are all at the end of the day paying and transacting in today's rupees, not of rupees from a few years ago.
Correct.
So nominal growth is less than 9%, 8 point something. Last year, GST collections. Now GST measures output tax minus input tax. It's the closest that you have to a real-time measure on nominal growth in India as you can get. Month on month, you get a reading of what the GST collection is. You know exactly that's the amount roughly that the economy has grown. Last year, net GST collections up 7% year on year. Again, nominal growth of 7%. Now, obviously, last year they did cut taxes, some of the rates, so that needs to be adjusted for. But the truth is somewhere between, let's say, 7 and 8 point something. Okay, that we grew last year. That is the lowest nominal growth since FY 2003. That is a 23-year low, but for the COVID year.
Okay.
Right?
So GDP growth, nominal GDP growth is as low as what it was in 2003, ex of the COVID year.
If you just leave that one COVID year out on a full year financial year basis, this is the slowest growth in 23 years.
Wow.
And
that's similarity number one.
That's similarity number one, and it matters a lot because when you look at Nifty earnings growth or sales growth of corporate India, it is highly correlated with nominal GDP growth. So if you have nominal GDP growth at 8%, well, the Nifty earnings growth is at 8%. So that's not a good place to be in, And 2 years ago,
I think all the investors would agree with you on that. Struggling with 17
you
months.
had 23 times Nifty PE 2 years ago for an 8% growth. So it's a tough sell. But that's not the only parallel to where we were in 2003. Between, let's say in the last 3 odd years, 3 to 5 years, post-COVID, the rupee has gone from 75 to close to almost 95. So it's a material depreciation we've had. 20-25% kind of depreciation of the rupee. And you see the 3 to 5 years prior, ending in 2003, where the rupee went from closer to 40 to the dollar to 50 to the dollar. Again, a 25% rupee depreciation.
Okay.
You saw massive underperformance of IT.
Because the dot-com bubble had burst.
Because the bursting of the dot-com bubble and because of the anti-AI trade or whatever this time around. Significant underperformance, I should say, not stock necessarily, but corporate underperformance by FMCG companies, consumer in general, because we had a very weak economy. Normal GDP growth being low is very bad for consumers, right? Because that is, we are, 55-60% of our economy is consumption. And that got affected because it was very low nominal growth, very low inflation. CPI inflation, can you imagine? I mean, in those days, it was difficult for me to imagine sitting over there because it was first time for us. 2.5% CPI. Now also we had 2% CPI
like
last
India,
year. In a country like India. And that time we were used to 6% per annum inflation.
Correct.
And we were suddenly at 2. Right? And this time we are used to 4 and we are between 0 and 2 in the last year or so. So again, inflation maybe 4 percentage points below its average.
Okay. So let's recap all the factors again.
Yeah.
The macroeconomic similarities between 2026 and the scenario that existed in 2023. So
in 2003.
In 2000. So let me rephrase that. Macroeconomic similarities between 2026 and where we were back in 2003. So what are the factors again?
Weak nominal GDP growth, underperformance of the rupee
underperforming,
struggling IT sector,
weak,
struggling consumer, low inflation.
And low inflation,
right?
5.
Okay, 5.
Yeah.
Now, what got us out of it? Because that's also important, right?
Yeah.
Or what ended it in some sense. Gulf War 2 versus Gulf War 3. 2003 was US-Iraq.
The Iraq
now
invasion.
it is US-Iran, but it's still the same area,
Okay.
similar war.
This is feeling eerie now.
Yeah, it's becoming very much more eerie. Also, consequence of which oil prices shot up then, and oil prices now. WPI inflation shot up to 8%. WPI inflation shot up to 8%.
9% last print,
Yeah. And so people were worried again. How can we survive this? We have consumer inflation low and input prices, WPI inflation high. This is terrible news for corporate India. RBI is going to have to raise rates and so on.
Oh God, and the same thing has happened. I'm just thinking about the RBI policy that happened a couple of days
people
back.
are worried about, when will the RBI raise rates?
Yeah.
And what happened? Did RBI raise rates? Yes.
Yeah.
Right? What happened to the macro? What happened to economy?
Yeah.
Economy did well, no problem. We are not structured. India is not structured for 2% inflation. We are quite happy with 4% inflation.
Okay.
Right? This is going to be interesting for a lot of people. I'm going to just talk about it because everybody individual in India expects to get an 8%, 10% increment every year, at least 8%. I hope most of you get that or better. If you assume that roughly half of cost structures in corporate India is employee cost, and half of that cost structure is going up at 8%, then I at least need 4% product price increase just to meet that cost.
So for better increments, we need higher product costs, which means higher inflation. So good inflation is good for our wage.
Up to a point, right? You do not want your salary to go up 8%, but inflation to be at 10% because that erodes your purchasing power. But you're happy if your salary goes up at 8% when inflation is at 4%.
Correct.
Everybody makes money. The companies make money. The
employee makes money.
Everybody is. But you need some inflation. Now imagine if you have 2% inflation, the corporates don't make money, which has been our problem for the last few years, that we've had input prices go up, also because in the recent past because of oil, and output prices are not keeping up, right? So margins come under pressure and so on. Anyway, it's a little detour, but there is a bit of inflation which is good for us. And I think what kicked us out of the 2003-2004 cycle was that we got a little bit of inflation back, a little bit of growth back, right? And then, of course, once that momentum got established, 4,000, 4,500 Sensex became 20,000 Sensex. I'm not saying that we're going to go up 5x in the next.
I was just coming to that. So what followed after this lull phase of 2003 and 4? And I remember because I had just finished my college. I was just thinking of stepping into financial media. What followed was the mother of all bull runs. I mean, from 2005 to 2008,
Absolutely.
It was a happy place, India and the rest of the world actually.
The absolute bottom of the market was in 2002. I think Sensex was 2,500 or something like that in the absolute low and that cycle.
So what are the chances of something like that repeating?
I think it's not exactly the same, but the chances are very high. One is we are already seeing signs of nominal income pickup. So the exit in the fourth quarter of last year was already double-digit nominal GDP. So while the full year was less than 9%, we started exiting in March quarter itself at about 10%. If inflation in India goes back to that 4-5% range, with the same 6-7% real growth, I'm going to use real with inverted commas because it's not something we can measure. But that means we are talking about 10, 11, 12% nominal growth in the next year, 2 years, 3 years. Now, if that happens, then your Nifty profits go up by 10 to 12% every year,
Okay.
right? The mid caps, small caps, which are already growing at 15% plus.
Mm-hmm.
If your large caps start moving to 10 to 12%, the mid caps can easily sustain 15 plus.
15% plus
Right.
mid cap earning growth.
They can grow faster than that, right?
Yeah,
so
yeah.
if they are already growing at 15 when
Yeah,
large caps are
yeah,
growing at
yeah,
8,
yeah.
if the large moves to 12, then they can move to well above 15.
Mm.
So this whole worries that we've had over the last couple of years, where we've had poor sales growth, all that worries suddenly change.
Yeah.
And suddenly India becomes, instead of a 20 plus PE market growing at 8, suddenly becomes an 18 PE market growing at 12. The whole mood of the whole thing will change.
Yeah. True.
Right?
True.
So I don't see this war and this whole impact as being negative. I think we do need a little bit of
A push.
a
It
push
gives us
and
the
a kick
push. Yeah.
to sort of get moving.
Yeah.
A little bit of inflation will lead to more cash flow,
Yeah.
more investments. And you see that reflected everywhere. To give you an example, bank credit growth is now sitting at 16-17% plus.
Correct.
Which, if you go back a year ago, let's say June, July of 2025, what, 9%, 10% credit growth? Now we are at 16-17%, right? Currency in circulation is rising, etc. etc. We become export competitive. Now we look at one side of the picture and say, oh, the rupee is depreciated. But, rupee is weakened by about 20% against the Chinese yuan. We've suddenly become a lot more export competitive. We've got FTAs with the UK, EU, potentially one with the US. All of this changes the entire picture. I think I'm not at all negative. I think the economic cycle is due for a massive uptick, and stocks will follow.
And this ties in very well with what we've heard from the Reserve Bank in the last policy, because while the whole world went into the policy thinking,
Oh, the RBI is going to be very hawkish, they will signal to the market that rate hikes are coming. They did the exact opposite. I mean, it was a very nice and benign sort of a policy. In fact, they've increased very small by a very small measure, but the GDP outlook for the whole year.
Right.
So it ties in with now what you're explaining and the way this is working. My question is, this is sounding extremely good, but what does it mean for investors? Where to park the money now for the next 3-4 years?
So I think it's interesting because the last couple of years, you've seen this massive divergence in performance of different segments of the market, right? So large caps have gone nowhere since September 24.
Correct.
So it's about 2 years since the peak, but mids and smalls have really outperformed. So if you look at multiples, for example, your large cap index is now trading at more than one standard deviation below long-term average. So just for everybody's benefit, what does this technical language mean? It means it's cheaper than long-term averages by a decent amount. Mids and smalls are trading similarly one standard deviation or more above long-term averages. So what that means is that they are trading relatively more expensive. So while we have seen this extraordinary outperformance of small caps, mid caps, etc., I think the rotation to large cap will happen. So you need to have more of a balanced approach. You can't just be chasing mid and small. The earnings surprise that I was talking. So people expect small cap and mid caps to continue delivering 15 plus growth, and I think they will. Right?
They've actually done better than estimates in the first quarter.
In just the first quarter, which was supposed to be difficult.
Yeah, because we were hit by a war and oil prices and all that.
I think the surprise is going to come in large, because that I don't think people are penciling in 11-12% growth.
Okay.
So when that happens, suddenly you will see a lot of people who are today underweight large caps wondering, I should be in this segment.
Okay.
So I think the large caps, so you need to have a little bit
So
of a
basically,
balance.
if you've been patient with boring large caps that are just not working in your portfolio, stick with them.
Stay there. And if you've
Hearing
only
it
been
from the big boss himself. Yeah.
and if you've only been in mid and small for the last couple of years, great for you. But please consider sort of shifting a bit of portfolio, diversified towards a little bit of large caps. I think that makes a lot of sense. So, and then even within that, right, you have had sectors like banks who really derated.
Correct.
Foreigners have sold them
Correct.
a lot. I
I'm
mean,
glad you brought
another
that
message
point.
of 2003.
Yeah.
Lot of foreign selling in that era also, right? And again, in the recent past.
On the point of foreign selling, and I'm glad you raised it because it was on my mind as well. Let's get this clear. So there's always this huge debate in the market, right? There are some people who say that for every buyer there's a seller. So stop talking about FPI selling. It doesn't matter to the Indian market. But my point is that as long as FPIs are constantly selling, even though we are buying as retail investors and funds like Axis and others are buying, there's still that selling pressure, right?
Yeah.
It's still more people looking to sell from
That's
a foreign
true.
perspective.
And
what is your view on just their relevance and the extent of selling? What happens if they choose not to love India the same way again?
So a few things, right? One is that there is a buyer for every seller, right?
Correct.
But that does not mean that both agree on the same price.
Absolutely.
Okay, so at the end of the day, it's a price they agree on, and if there is a large concentrated selling and very diverse buying, it does change the way the price clears. Okay, so it is not to say that the prices, but these are opportunities also. Like active managers, we love it when there's distortions like this, because that's what gives us entry into some
valuations having come down
valuations coming
finally.
down, right? So we have no problem inherently with large groups of buyers coming and selling and etc. etc. That's perfectly fine. But remember that foreigners, they've sold in like, $20 billion per annum, right? It's a kind of run rate at which they've sold for the last couple of years. What do they sell?
Large caps.
Well, that's because that's all they own.
That's what they have.
Right? That's what they have.
Yeah,
So
yeah,
if you own large caps, if you own a large amount of banks and IT and FMCG, etc., which is what they were owning, then that's what they will sell, right? Buyers, on the other hand, if you look at the flow data into mutual funds as a proxy for what are Indian investors interested in, it's been a lot more diversified, meaning it's not concentrated in the large caps. A lot of money is coming to mid cap, small cap funds, diversified funds like large and mid cap as a category, or flexi cap, multi cap as a category, etc. So Indian investors have been more diversified in terms of what they buy, and the selling is concentrated in large cap. So that's one more reason why this relative performance difference comes into play, where your large caps underperform, right? But that all comes to an end the day the foreigners start buying. And if you look at the last couple of months, that mood is already shifted. I don't think foreign investors look at a love for India as a reason to own or to sell, right?
I meant love in monetary sense, strictly monetary. Kitna paisa dalenge, kitna banega, what is my return,
and that's
what's
the
my
problem,
cost?
right? So like I said, expensive market, 8% growth. Now 8% anywhere else in the world people are going to be happy with, but not in India, right? Not for the valuations but the valuations have corrected.
And the fact that the mother market itself has done so well.
Right.
I looked at US earnings in this quarter, going by some of the aggregators, and I think the average earnings growth in the US is over 25%. How do you fight with that? How do you argue with that at that size and scale of companies, right?
So, and that's again, I think we need to discuss that. It's very important how this whole AI trade is likely to play out. I think it's extremely important to discuss that. But the limited point I'm trying to make here is that our growth outlook is improving. Our valuations cut. Today, India is trading cheaper than US and Japan on a PE basis, which was not the case a few years ago, right? So what's happening is that where India used to be significantly more expensive than the rest of the world, we are in line with the rest of the world.
Right.
So we're not expensive, and for a pretty decently growing market, we are now not expensive. We are in line with the world. So that changes the maths from a foreign investor's perspective. I mean, we do advisory for international funds who invest into India. For last couple of years, it's been a drought in terms of new money. This year, we have signed up 2 new clients. So the way I look at it is that people are looking at India suddenly and saying, okay, India suddenly become cheaper, more interesting, more attractive. So there, if at the margin, actually there is money coming in. So that all that psychology is changing. I want to spend a moment also in terms of this whole AI trade, and we have a very different take on the risks that's there. Because again, going back to the 90s and 2000s as an example, right? Alan Greenspan very famously, he made the statement about irrational exuberance in the markets, right? In 1996. And from there, the S&P 500 doubled. Okay. The Nasdaq I think went up 3 times or something, or 4 times after he made that irrational exuberance statement. So whatever I say, I'm not Greenspan, and please take whatever I say with a pinch of salt, because he couldn't forecast what is exuberance. I can't.
What markets can do,
But every capex cycle is the same, and AI is a capex cycle, right? If I'm a producer of AI hardware, graphics cards, memory, RAM, flash, whatever, CPUs, foundries, everybody, we are hardware companies, right? Let's say you're a data center and you place an order worth $100 billion to me to provide you chips and other hardware. That's revenue for me today. That's profits for me today. I'm going to make revenue and profits out of that $100 billion of inflow. For you, that's a balance sheet item, and you're going to amortize that over the next 5 years, 10 years, whatever, according to your policy. So what have we done? Our cash flow is the same. You've lost $100 billion. I made $100 billion. Okay, between us, cash flow is the same. But our profits have gone up. because I'm showing my profits today,
Yeah.
but you are not showing a expense today. So why is it that US, Taiwan, Korea, Japan, why have they shown extraordinary increases in profits? Is because they are providing capital goods,
Yeah.
and capital goods always recognize the revenue and profits upfront.
Yeah.
The buyer of capital goods will amortize it over time.
Yeah. So basically, both parties are showing a better P&L.
Yes,
For different reasons.
For different
Yeah,
reasons.
Yeah, yeah.
Now, the day this party comes to an end, and it came to an end in the year 2000 in the last cycle, it probably has not come yet to an
Yeah.
end this time around.
Yeah.
What will happen? The day the new orders stop, the capital goods providers' profits dry up
Correct.
because I need
Yeah.
new orders and new production
True,
every
true,
year
true.
to show their profit.
And the guys who had given the orders, they have to start.
They
now
still have to
finally
amortize
yeah, they have to
those
show-
expenses,
make it
right?
Show up in their,
Yes.
books.
So over
Yeah.
the cycle,
Yeah.
the P&L has to match.
Yeah.
Although it is time shifted. Now what we are seeing today is data center companies are borrowing money
Yeah.
to buy technology products, right? So which means debt on one balance sheet is profit on another on the
Sure.
P&L.
Sure.
Is the same issue that we saw in 2000 2001, where we saw extraordinary leverage getting built up, and then all the thing came down like a pack of cards, right? Are we there yet? I don't know. Who's going to know? But I think it will come, and this is a risk that we need to sort of be aware.
Something to
This
watch.
whole AI trade is a capex
Yeah.
trade. It behaves like every other capex trade that we have seen so far.
True.
AI technology is astonishing. And again, I'll say that if you go back to the 90s to 2000, the companies that made the hardware of the internet, right? The switches, the supercomputers, the microcomputers, and the networks and fiber cables and all of that stuff which was built.
Yeah.
They are not the beneficiaries of the internet.
True. 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 The users.
The users, they are the ones who benefited. And in much the
adoption.
same way, it is not obvious to me that today's hardware companies who are also providing the plumbing for the AI apps
Yeah.
are necessarily the beneficiaries of these AI revenues going forward.
True. True.
So a whole new crop of companies and businesses will emerge
Yeah.
who will develop apps and who will probably be the net beneficiary of this entire cycle. So that's an opportunity we will wait and play.
Okay, so that's the take on AI. Definitely something that we have to watch and see how it unfolds here in India as well, right? But now, if you have 2 more minutes, I want to come to brass tacks because everybody who's watching this show ultimately wants to know where to invest and how to make money. So, should we
Sure.
step outside
Yes,
for
of
the
course.
quick last chatter? So now, having understood that things could be actually in a very interesting place, from where the next bull market may begin, having understood that and wanting to believe that, first lesson you told us was don't let go of your large caps now. If you've stayed patient so far, stick to them. That's lesson number 1. Where else would you park money now?
So, one of the things is that for most investors, keep things simple. That's the easiest way to make money. But if you really want to look at, how do you want to optimize your portfolio? So obviously, when you look at the mutual fund space, you have diversified categories like large and mid, multi-cap, flexi-cap. I think for most investors, that's the right way to be in. There's also been a rise in sector and thematic. People have this thing of chasing the next story, the next theme, etc.
Every bull market, you'll see all the NFOs on the thematic side, right?
And there isn't anything inherently wrong with that, and many people have made good money on some of these themes and sectors. But I'll just say that look at some of the ignored parts of the market also.
Okay, like, give us some examples.
I think banks, which have really struggled for the last couple of years in terms of, they've shown good growth. The credit quality cycle has been on their thing. But of course, margins have been difficult and the foreign selling has been relentless. There's been a lot of underperformance, especially with the private sector banks. I think that's a pocket of opportunity people are ignoring. And auto ancillary. Some of these are well discovered, but there's still huge amount of opportunity. I think people underestimate how much opportunity there is for manufacturing in India.
Okay.
Because one is, of course, it's a policy push. But just to give you this statistic, sort of really woke me up. India's share of world services exports is about 5%. Right? India's share of world manufacturing is less than 2%. It's about 1.6%. Okay. this is changing. This is changing because of FTAs. This is changing because of the currency depreciation, PLI, all of these schemes, etc. If our share of global manufacturing goes to even to 2% or 2.5%,
Okay.
which is a movement of 20, 30, 50 basis points for the world, and
Yeah.
therefore no one else is really going to notice it.
Yeah.
But
yeah.
for us, that represents 20 to 50% or more increase in export opportunity because we're starting from an extremely low base.
Yeah.
So we've seen that already happen in a few sectors like electronics, etc., but also in auto components. I think it's a secular thesis for a long time.
Okay.
Some of those stocks are very expensive, so there is a caveat there.
That's why I said, right, growth at reasonable price. It's just this utopia.
But what's also happening is that especially within sectors and themes, early on in a discovery phase, what happens is everything gets lifted up because no one knows that if they like the theme, it's a new idea.
Yeah. You buy first, think
You buy
later.
first. But after some time, when things become expensive,
Yeah.
the market starts to winnow this and then
Yeah.
Separate the
Yeah.
wheat from the chaff, as they say,
Correct,
right?
correct.
And look at valuations more closely. Look at who is able to actually deliver.
Yeah.
And it's not just sector or theme, but what's actually happening at the company.
Yeah. Yeah.
So that's what we are focusing on right now. There is such a huge, the opportunity is huge, but out of all the companies, who will actually benefit? So we discussed the fact that we have expanded the universe of investments at the beginning of this conversation. What's actually happening is our portfolios are getting thinner. Because we need to now really be selective about what we own, even in the sectors or themes that we like.
Okay.
Right? So it's not about it's not that those companies are not growing. There will be a lot of growth.
Yeah.
But some of them are just too expensive for what they deliver. So this blend is very important. I think coming back to early part of the conversation, I think growth at a reasonable valuation is
the mantra.
Yep.
I mean, as impossible as it may seem to find, but at least in the last, I think, year and a half, the valuation reality has set in.
It has, and that's exactly right. Especially over the last 12 months.
Correct.
And certainly over the last 3 to 6 months, we've seen, for example, power companies just running up because some data center might at some time in the future place an order. And that, now people are waking up and saying, do you really have a story?
Are you supplying really to,
so those
data
questions
center?
are being asked,
Yeah,
and
yeah.
so it's again, the value of research, the value of discipline, all that is coming into play.
So tell me one thing now as we are winding up. In all of this, given the information and the news and ever-changing markets, what is your personal mantra for cutting out the noise, for keeping the sanity, and for staying focused on the inputs and the information that really matters? How do you do it?
Yeah, it's sometimes it's very difficult, especially when we are in markets all the time, right?
So
we are
much is
in front
hitting
of
you in the face,
screens
right?
and everything is hitting you. So one thing I found very useful is to completely separate my personal investments from my professional, right?
Okay.
So I have, I really looked at recently some of my holdings, and I have holdings which go back to 20-25 years.
Okay.
And not a lot of it because I didn't have money when I was 25 years old. But the thing is, I've not really churned or chased anything. It's some of just basic asset allocation stayed there for 20 plus years, and I think you need to do that, right? A large part of our portfolio decisions only work. What they say, right? Time in the market is more important than timing the market. So that allow the strategy to play out is, I think, more valuable than trying to say that how many tweaks can I do to increase my returns by so many basis points in a year.
Okay. All right. On that note, fantastic. But if you could just help me, understand how do I reach Gop's cabin?
Please,
B.
follow me.
Gopkumar, who is the MD and CEO of Access Mutual Fund, and is one of the most interesting guys to speak to in the asset management world. Lots of ideas on what's going on in the industry. So I want to pick his brains as well for a bit. So should we just go to his cabin?
Please. Let's go.
Okay. Oh, there he is. I can see the man there.
Hey,
One of the most elusive characters, I think, in asset
Right.
management in India. Hi,
Nice
sir.
meeting you.
Thank you so much for having
Thank
us
you coming
over.
to our office.
We
Thank
have
you so
been,
much.
we've been to your cafeteria. We have been seeing all your floors and enjoying the Friday vibe in your office, which is quite nice, I must say.
yeah, we are in a Friday dress. Just look at us.
Very
We usually
cool.
are tied and
Very
suited
cool.
and Very, very formal
I picked
guys.
the right day to be here, then I'm sure.
Thank you. This is the first Friday I got it from how many months I don't know.
Yeah?
Yeah. Thanks for
Okay.
you.
Superb. Great timing. So I've had a phenomenal conversation with Siva. And guess what? Forget equity funds. He's convinced me that I need to immediately run and after the show go and do my investments in my fixed income funds.
Is it?
Yeah, imagine that.
But she's getting very close to retirement, she said.
I hope, fingers crossed, I retire early. But Siva, thank you so much. It was a great conversation.
absolutely. My
And
pleasure,
I will
Sandy.
let you go.
Yes.
I know it's a trading day. You've got a busy day ahead for you. But thanks very much
Thank you.
for taking out the time. And Gop, if you can spare 5 minutes, some thoughts. I'm sure you have
All for
interesting
you.
anecdotes
All for you.
for investors. Okay, so let me tell viewers, Mr. B. Gopkumar has been heading Axis AMC for now over 4 years, I think. Yeah?
Almost 4 years, yeah.
And he's an out and out BFSI man who's been, I think, with Kotak in the past on the broking side. Or tell viewers a little bit more about yourself. Come.
I did 32 years of working. Out of the
32 years, huh?
Yeah, 26 years in capital markets.
Wow.
Did quite a lot of things. Early start on a PMS day in capital markets. That was Kotak Securities. I spent 16 years in Kotak Securities. And in between, I went to the bank.
Yeah, Axis
I
Bank.
call myself as a some field. No, Kotak Bank.
Kotak Bank, okay.
And I was part of the Privy League program. And I came back to Kotak Securities to run the securities piece. Then I went to Reliance Capital, which is Reliance Money Group as a CEO there. I wanted to be a CEO. That's a problem.
And here we are.
Yeah. That lasted for 2019. In 19, I came to Axis Securities as a CEO.
Okay.
And
okay.
last 4 years, I moved to the asset management now.
And here you are.
Yeah. And it's all about capital markets for the last 26 years.
Got it. So, what would you tell someone who's getting into financial services today? Is it a good career choice?
Great career choice.
Yeah.
I
And what
think
part of finance should someone target? Any youngster?
Today it gives you a large opportunity for you, very large opportunity, large breadth. Because when we started, we are only lending business. Where
Correct.
you have huge jobs in the banks, NBFCs, broking, wealth management. I think it becomes much vaster than what it was earlier. You can also do a career on reporting and financial reporting. What do you do? Yeah, so
It's laborious. Let's talk about jobs that pay really, really well. So, but seriously, a lot of people look at BFSI as a very well-paying sector as well, and that's why I don't know how many people think about their aptitude and the love, and the money is very glamorous, right? So, what would you say goes behind that glamour, which youngsters should be prepared for if they're looking to make a career?
I think it's quite a stressful job. It's not easy because, especially asset management, when you manage somebody's money, it gets you a huge responsibility to what you try to manage.
True.
And even the similar in the lending business. So finance services is not an easy business where people think about.
Yeah.
It requires resilience. I always call resilience is very important because you go through cycles, whether it's lending or you're doing asset management.
Or capital markets. It's all a cycle, yeah?
It's a cycle and cycles can be painful. There are cycles which I thought the day is over, but I still survived 5-6 great cycles.
Okay, so speaking of survival skills, since we're talking about that, what do you think are the survival skills that you've picked up along the way that have served you really well?
I think it's just about resilience. I think just be in that, put your head down and work, and there are a lot of noises will come through your lives. I think, especially in capital markets are full of noises. And interestingly, when you speak to Shiva or Devang, nowadays I hear more noises in fixed income market than the capital market.
We were just talking
business.
about that I was asking him the same question. How do you retain your sanity and cut out the extra noise and stay focused on what's important? What's your mantra for
See,
that?
my mantra is simple. That is cut out objectives, right? For example, what we think about our asset management company is that we want to be a top 5 player by 2028. If that's an objective, what we need to do to reach there? I think whether it is trying to work on our investment process or build a high quality team, high quality senior management, this is what we try to build on.
You came in at a time when the AMC was going through a big transition.
I was just waiting for this question. I've been answering for the last 4 years, but
I have to ask, right? Because
Yeah,
people are
yeah.
wondering that how things have progressed and changed
Yeah.
at Axis, and I'm sure you would have had your share of stresses as well. A lot of management change as well. The investment team, the whole framework was overhauled. So, how do you describe that journey and where the house is today?
So the way I look at it is that individually it is a large opportunity for me to come in the time when there was a large, I call it a large PR event than a real event, because the last regulator has and final outcome was in last 2 weeks back. And interestingly, if you look at, it's a
Okay.
145-page report.
Yeah.
And there were not a single name of the present employees and the old employees, obviously, one individual was there,
Yeah.
but not on the firm level. There were
Yeah.
zero observations
Yeah,
on that.
yeah. So I mean, in case you're wondering what Siva and what Gopin and me are talking about, there was a regulatory issue that cropped up. Certain, misses were there, and then since then a lot of changes happened.
I think-
and now we're talking about everything going back in place in terms of compliances, regulations,
yeah.
risk management, and all of that.
Yeah,
Right?
if you really look back, what are the three things we talk about? One is that we look at very clearly strengthening investment process. We talk about it, we continue to be a growth and quality style guys. We've not changed it, but we bought some tilt on our valuations and the way we look at
I was
portfolios.
just speaking to Siva about that.
Yeah,
Growth
so-
but now reasonable price.
reasonable price. And more interestingly is that we were running a very concentrated portfolio. Today we are much more diversified. I think that's a strategy we did much more, and our active shares are above 60% in most of our funds.
Okay.
And that gives you an opportunity to say that the fund managers are able to take conviction bets. I think that's the investment process we change. We had a couple of guardrails which we worked on now.
Okay.
Another area is that we strengthen our senior management. And we got a great talent from the industry now. Very, very committed, long-term in one entity. That's what we built on. The most important is that we manage public money. So compliance and risk is very important for us.
Absolutely,
That stands
absolutely.
to our system. So if you look at our this office, we have enough automation in this place.
Absolutely.
Not
And-
only from a risk and compliance,
Yeah,
it's also from saying we come from a large entity called Axis Bank, which is our subsidiary. We are a subsidiary of that.
Yeah.
Very important to manage clients' money.
True, absolutely.
And-
Okay, so with that base now having been set, I think it's a good time to talk about the future and what lies ahead. I'm excited to know. So
Yeah, please come.
Should we sit for a
Please
bit?
come, yeah.
So this is the corner office with a great view, I must say.
Thank you for
It's
coming. again.
really,
I'm
really
so-
beautiful. It's wonderful. It's very, very nice.
The interesting thing I talk about this cabin is that this side looks like a Hong Kong. You look at the buildings, what we look at.
20 years I've been working in
Yeah.
this area of Lower Parel,
Yeah.
and I can't imagine how the skyline has changed.
And if you
Sometimes
look
I
at-
wonder, when did this all happen? Yeah.
Look from behind, it's the reality, right?
You can still see some of the old mills
That's what
of
I'm
this
saying.
area. Yeah.
This is Bombay reality.
That's Bombay.
This is the new Bombay.
That's Hong Kong, and that's
Yeah.
Bombay, or as it used to be
Yeah.
back in
It's
the day.
actually brings me a lot of reality. Yeah. So Ravi, I think when I think about this both, it's very interesting. I think this actually grounds me when you look at it.
Yeah, I'll tell our camera person to also show our viewers zoom over there, because what we can see, what Gop is talking about, are the top side of the mills, the famous textile mills of Mumbai. Not too many are remaining now. I remember when I came
That's
to
the old
city.
Bombay. That's the feel
Yeah.
of a Bombay.
That's
This
true.
is the new Bombay where you see
Yeah.
all the skylines here. Just look at and you can see a sea
Yeah.
from here.
True, and the beautiful skyline and the sea and the coastal road, all of that. So it's transition, right? Talking about the transition of the city. So the transition for you. Now we've discussed. I mean,
Yeah.
stuff has been put in place. Now, what is the challenge that you have given yourself and your team? What next?
So multiple things. I think if you look at last 4 years, we really worked on the investment process side. And if you look at our funds are today are much better shape. The most of the funds are now in first quartile. This is also because growth still came back, quality played well, the portfolios did well. I think that's my ultimately as an asset management company, we have to deliver it as the investors. That's the ultimate outcome of this.
True.
The way these organizations are built on.
True.
Couple of areas which we work on is that there are a couple of areas we are late because a lot of people don't know about us. We are the youngest AMC in the top 10. This is
Youngest
a
AMC?
We are only 17-year-old.
Oh, okay.
And to be a 6th largest in equity and 8th largest AMC, but if you remove the government money, we are 7th largest AMC in this country. We reached almost 3,94,000 crores as on yesterday, a short of 6,000 crores for this. Having said that, there are 3 or 4 areas which we want to focus on. One is in passive side, which we are typically late because we started our journey in 2019 compared to other peer groups now.
So out of all the funds today, what's the breakup in terms of how many active, passive, fixed income, equity?
So we run
Or
almost
hybrid.
84 schemes.
Yeah.
And the substantial portion is on the fixed income and on the pure equity.
Equity
diversified
side, yeah.
Equity
Yeah,
side.
yeah.
This year we are launching, every month we are launching one passive funds. We just finished our capital markets, now we're launching energy because we have a lot of catch-up game. Second, very important is that we want to pay the thematic way. For example, capital markets is the largest theme. If you think that 3 years market's going to do well, then the index funds will do well or ETFs will do well.
Okay. So thematics,
Thematic
you'd
we
want to play
in
through passives.
Passives.
Okay.
That's one area which we are certainly excited about. One of the other areas which we want to build on is on the alternate side. Alternates is one of the large opportunity for us. So on the PMS side, now we bought out the Access Securities PMS now. On the active PMS side, which is pure equity side, we are almost now around 7,000 crores now.
Okay.
And all put together PMS, we are almost like 19,000 crores now. There are large mandates now.
It's very interesting that you spoke about PMS because the regulator is also now thinking of maybe changing some rules around
that's right.
PMSs and the PMSs which are being run by mutual funds. It's all draft regulation. Even I have to go through the details right now. But since you've touched upon the topic, why don't you tell us a little more?
See, it helps you. There are a lot of things we can do now.
You don't have to have a threshold of 50 lakhs, for instance. If this regulation goes through, then for a lesser amount, you can, retail investors can participate in
I have
PMS.
seen the cycle, Surabhi. I started my career when Kotak Securities, PMS at 5 lakh rupees minimum.
PMS at 5
lakh
lakh rupees go to PMS manager. Oh.
After
Today the threshold is 50 lakhs.
And from 2004, 5 lakhs was too big money that point of time. And
that's also true.
our average ticket size was 10 lakhs. 2008, when the world crashed, the regulator believed that it has to be higher limit. So we went to 50 lakhs. I'm happy to see that we have come back to 25 lakhs. One of the entry levels are much more easier. There are couple of things which allows you to be much more flexible now. Your ability to take some options, features, hedging the portfolio. These are the things which is come into play. We need to wait and watch how the ultimate the regulation is going to come. I think that's what I'm waiting for.
Okay. So PMS could be one
So
growth
PMS
area
is
for
a large
you.
opportunity. PMS and the AIF and the CAT 3 PMS on the listed side.
Okay.
We are running a structured credit now.
Okay.
That is one piece which we think that is an opportunity for us. We run a PE growth stage one. We also run the real estate fund. It's a real estate commercial fund. People don't know that we construct 3 large buildings in India now.
Really?
I
didn't know
along
that
with
also.
Fishman Spire. That's our real estate fund.
Okay.
So alternate is a large opportunity now because if you think about last 10-15 years, the HNIs, the UHNIs, now on a different set of products, the willing takes a couple of risk levels are much higher. I think these products, we think that's largely highly scalable now.
So now I'm coming back to the retail side. The general janta, which is keeping up the capital markets, the equity market of the country, of course, in decent spirits. Here, Gop, tell us through your lens, and you've observed investors. What is the biggest change, maybe in mindset or patterns of investing? What is the biggest change that you've noticed in the last couple of years?
I've always said that I'll read history saying AD and BC. Now I'll say pre-COVID and post-COVID.
Pre-COVID and post-COVID.
I think the new generation will talk about, our generation will talk about AD and BC, right?
Yeah.
Now it's about
pre-COVID, post-COVID. Yeah, and then soon it's going to be pre-AI and post-AI.
Yeah, I think, we'll have that conversation. Any conversation doesn't end with AI. I think 2 things have changed. The savers and saving mentality and the protection products. Saving products versus protection product. Protection product also did quite well because people started realizing the human life cover is very important.
True.
I think you have seen this huge surge of want of insurance policies, whether term or life insurance. The another change saving product is that there are a lot of people came to markets and said, I want to start saving.
May I borrow your bottle for the water?
Yeah, thank you.
Thank you.
Thanks for asking.
Thank you so much.
Can I go for you?
Thank you.
The interesting part is that when you look at, there is a quite number of new investors came into play. And that happened. Second is that all the digital platforms become much more efficient. So Bharat played very well.
Yeah.
So Tier 2 and Tier 3 cities started participating in the saving products. Whether you can, even including bank accounts have been digitized. So in that sense, it was so much more easier to do it. Third, my problem, the way I think about it is that now a lot of people are start talking about retirement planning, financial planning, asset allocation. I think people have started measuring their outcomes at the particular age, whatever level of risk one they want to take. I think that's the largest shift. So if you go back
So
into
investors
the,
have become evolved.
Quite
From savers,
evolved.
we've become more evolved investors.
yeah, I think the only difference is that people still don't know that investing in mutual fund is investing. They're not saving. So they have to come through that reality of volatility.
Yeah,
I've always
yeah,
said there is
yeah.
a difference between investing and saving. When
That's
you
true.
save, you save money in FDs.
Correct.
So a lot of people ask me, I save money where? I save in mutual funds. I think you're an investor.
That's an investment.
As long as you're an investor, you have to go through the volatility.
That's true.
That's the
That's
reality.
true.
I
That's
think
true.
a lot of mind shift changes have happened. And the biggest thing is digital. Digital
Yeah.
has really, and DIY customers have today become large component. If you look at
How large? I wanted to understand that because sometimes I wonder that having spent more than 20 years in financial media and reporting on financial services, if you tell me to pick 5 new financial products to invest in, even I will sit back and think and wonder if I want to take someone's guidance or consult someone. So sometimes I wonder how a lot of the younger folk who are buying and selling products on an app, what's your thought around it?
See, in my career, maybe the 6th or 7th app I've done in my career. I've always said that digital is more a mode for a business. But having said that, these platforms have become much more efficient. Very, very efficient platforms where you are able to decide, you have multiple choices. And if you look at any platforms, they have become much more, you don't require to have that so-called knowledge what we used to do earlier, read books and come back and buy some products. But today it is much more easier to buy, easier to
But it's
understand.
knowledge. It's very easy to buy and very easy to sell.
Understand. There are different models people work at. We can't. I don't want to comment on different platforms have a different rating process. Then there are individual rating agencies which you get rated. But having said that, if you look at 65 to 70% of the new customers are coming through fintechs.
65 to 70%.
Yeah, that's our
of
number.
mutual fund customers.
Yeah, you look at SIPs.
Yeah.
My 60%
Wow.
SIPs comes from fintechs.
Wow.
These are all new set of investors.
And
My
you're-
MFDs are not going to get new set of investors. They are not in scale. These guys are huge scale.
So, which is good news, I guess, for your business, right? Because the cost of getting that customer would be a lot lower than when he or she is coming through the a fintech app.
If you
So,
look
what
at,
does it mean for this rise of this digital channel? What does it mean for a fund house, say 5 years down the line?
so today, if you look at the way we have structured today, for example, we have our mobile app as well as the website. Very interesting. I think we are the earliest AMCs to say that we build our own. We don't have a third party app. So we have our developers, UI, UX developers, and all these things. I think my view is that even the AMCs have now ensured that they have enough repository of APIs. For example, when fintech has to come in, I need to give our API. So we have an API stack. Now, asset management companies also become much more technology companies. We have a repository of around 650 videos. And every day we create some videos because all this fintechs requires product videos. So we have a largest market share. My view is that we are the top, should be top 3 in terms of market share in terms of fintech. We still have 10-12% market share in fintech. Substantial portion of our customers today comes from fintech.
That is a big learning for me as well. Just the power
They may
of the
not be
digital
in terms of
media.
average size, but
Just the number of the new
clients,
number of customers,
new
maybe
clients coming in.
new clients coming, new folios coming in.
Yeah.
God, that's a very interesting trend. Now going forward, we talk about products, and you said you're very focused on passives. How do you see the industry evolving? Because let's face it, finding alpha has become more difficult.
that's right.
I looked at the last SPIVA report again. And again, just telling viewers that SPIVA is basically an industry report which tells you how active funds and passive funds, the difference in performance over there. So, large cap funds 80% mostly underperform according to that report. Mid caps, at least half of the mid cap funds underperform the benchmark index. In this environment, how do you see the balance between active stock picking, the rise of passives here in India? I'm talking you to now look ahead 5 years and tell us how it's going to be here.
See, if you look at the overall AUMs and passives, substantial portion of the AUMs comes from the institutional investors.
The EPF money and the pension
But
money.
if you look at,
Yeah.
it has become today a satellite allocation for customers' portfolio. It's not going to be a main line. Even today, in the next 5 years, you tell me that in India, whether 100% of the investors will go to passives, my answer is no.
Okay.
My view is that it takes longer period of time to achieve that maturity. I think next 5 years active should do well. I don't think, I'm not in the camp of saying that active fund managers will become a passives and fund managers will not beat the benchmark. Our job is to beat benchmark. That's why we charge fee, right? Otherwise, we have no right to charge fees.
True.
In my view, I think that's what we tell. And I think my view is that the way index are formed today and the way the active shares the fund managers are now working on, I think beating benchmark is not so difficult in my view. It's not as of now.
Okay.
If the breadth of the market increases, number of stock increases, then there is a chances. I've always said that Nifty 50 can be always an active fund because the way the Nifty's weightages are constituted. You have sector-wise, there is a high level of concentrations, right? And you have a single stock concentrations are very high.
Sure.
So in that sense, you still can beat an active fund manager can beat the index. But there are cycles. I agree with you. There are cycles which can be very painful where they will find difficult. But these cycles are not too long. When you look at, you would have done this study that if you look at fund managers not beating benchmark, it's not going to be a 3-year phenomena. It's a very short period of time.
Okay.
Short period of time, you may underperform, but on a 3-year or a 5-year basis, you still see that
Performance will come back.
Will come back, and fund managers are beating the benchmarks.
Yeah, well, we hope for that. Absolutely, that's what active management is all about. So let's talk about, let's say, if I were to ask you for a medium risk investor, every investor has their own profile, but if you were to pick 5 types of funds, say for me, medium risk, don't need the money in the next 2-3 years, across asset classes, all the options that the mutual fund world right now, offers. What are the funds that you'd
I love
tell me to
multi-cap.
have? Multi-cap. Huh?
You look at my personal portfolio.
Okay.
I love multi-cap.
Okay.
Because you got
and why multi-cap? So multi-cap will allow you to keep, investment in large, mid and small.
So you have 50% large.
Yeah.
25-25. So easy to manage.
It's
you get
fixed.
all the flavor.
Yeah. So basically your investment is fixed. 50% of it has to go to large caps, 25% mid and 25%
So
small,
why I'm
right?
saying that a lot of people will say put money on flexi cap.
Flexi cap, yeah.
The problem in flexi cap is that substantial portion of people, fund managers are in large cap. And if you look at, they're at 60-65%. My view is that they find very difficult to come back. And they have to find an answer for the gap what they will bring in. They have to add up some mid and small. Today, all these funds run mid and small. So the question to fund managers is whether I should have put stock in these funds or should I put in the flexi cap. So my view is that given the flexibility, it is finding very difficult for the flexi cap managers to move.
To actually come back.
Actually move. And this is the truth. And nobody has spoken it publicly. I'm saying that it's very difficult. Multi-cap is very clear because you have caps of 50% on large, then it's mid and small.
You have to have that proportion of stocks. Yeah. But because...
And if you compare, it is a similar product. Compare with a multi-cap and a flexi-cap. On a 3-year basis, 2-year basis, even 1-year basis, multi-caps are done extremely well than flexi-caps. The differential is at least to 4-5%.
Multi-cap funds have done or have beaten flexi-cap funds by 4 to 5%.
Yes.
On a 3 to 5 year horizon.
Yes.
Oh, that's great data. Something worth going back and
please go and
doing
check.
some homework on. Absolutely. But because multi-cap funds are more true to label, they are more diversified than a traditional flexi-cap, which is more large cap oriented. Would multi-cap funds necessarily be more risky?
It is not.
Okay.
Because it participates in a fairly good risk profile, right? For example, large cap is 50%, so some level of risk is reduced in terms of volatility.
With the large cap allocation.
Then you have 25 mid and you got a 25 small. So you got all the mix of the markets.
Okay. All right. So
and typically, if you look at portfolios, are not more than we run our 120 stock portfolio. That's the range what we run between 90 to 120 stocks in that portfolio. So it is not too diversified that you're not capturing the alpha.
Got it. So multi-cap is one mantra. Okay. The 2 passive funds beyond the Nifty 50. We're not going with Nifty.
I really don't like the proper index fund. Sorry to say that.
Okay.
I like the themes like capital market index.
So you'd go for a capital market.
No, why? People, if you have a view of next 3 years, you find it very interesting that capital market. And if you look at capital market companies and look at the compositions and look at, these are operating leverage companies. So if you look at multiples what they get, average multiple is 40 times. What did it say? 1 rupee of PAT. You get 40 times. No other index gives you that operating leverage.
Okay. So capital markets, you like as a theme, you'd play that through a capital markets
and
index fund.
There is a valuation positive tilt in terms of valuation what you're going to get. And when you look at this, I think they have a 12 stock strategy there in the index. They are one of the best companies. There are 3 platform companies, there are 4 AMCs, there are 2 broking companies, and there are 2 RTAs.
Okay. Yeah. And why not? You've spent the bulk of your life in the capital markets business, so you know the business inside out. So I take your word on that completely. What else? Any one more passive fund? Passive. It could be thematic. It could be anything else.
So,
what else?
No, I like EV. I don't have an EV index.
Okay.
We will bring in some point of time.
Okay.
So if you look at all the numbers, I think Shiva would have spoken about EV. EV today, what penetration? We have 6% penetration. Just look at if it goes to 12%.
Okay.
So things has to play that way.
Okay.
I'm not saying that I don't like the Nifty 50, Nifty 100.
Yeah.
I think when you invest, you need to think about the valuation of these portfolios, right? When we talk about active funds, we talk about it. But I think when we come on index fund, we just invest because you say, oh, it's low volatility, just I'm buying it because. And second is that when you look at any of the passive funds or even international investing, I always said that it has to be meaningful in your portfolio. Otherwise, it's been insignificant.
True. True.
Very insignificant.
So speaking of international investing, I'm glad you asked that. Coming to final thoughts, and that's also a lot of experimentation is happening there, right? Because a lot of Indian mutual funds still can't accept more money in their global funds because of regulatory caps. So I'm hearing a lot of AMCs now starting some structures or products out of Gift City.
Yes.
I mean, tell us what your thoughts and plans are around that, and what would your advice be to Indian investors who do want to own some global equity?
2 ways to look at it. So I spoke about passives alternates. I think another area which we are focusing on is on Gift City.
Okay.
Our only one fund is live, it's the institutional live side. Very important to think about is that we are building a digital journey now. It's very painful for a retail investor to invest in a typical Gift City fund because it's all paperwork. It takes. I also invested. I know it took a long period of time to get the money there. I think most of the AMCs is also figuring out the digital journey. We are working with IFCA to do that. I think idea is that how can you bring in a low value ticket size today? And today the regulatory limits what IFCA is talking about is $5,000. We would like to start with $100 SIP. And that's going to change now. Next, my view is that Q4 onwards will
just telling viewers, IFCA, I think you mean the
IFCA
International Financial Sector,
yeah,
basically the authority, the regulatory authority of Gift City, in case you were wondering, that's what
so we are working
Gopi is saying.
Quite closely with them. I think a lot of funds will see from Q4 onwards. Lot of funds.
That'll be another interesting investment horizon.
Yeah, you can buy an emerging market, you can do a country-specific market. So you can.
Will it reduce money coming into our local market?
Not exactly, because it's an allocation, right? I always said it has to be a meaningful allocation for customers' portfolio. Otherwise, please don't do it.
So it won't be a risk like, oh, liquidity is drying up here in
my view
India.
is that, there's a lot of FOMO, right? You look at the FOMO, what happened recently, that we just ran out of limits in 30 days. We just lost, people just came in and bought it. I think that's a problem. The FOMO is a problem. I think my still belief is that Indian market should give you a 12 to 14% return. So why do you want to take a risk of putting money? But it's individual choice to.
12 to 15% return.
Yeah, it is. On a longer term, it has delivered.
So still believing
you
in
still,
that story.
You still want to put money in a country which we may not know. But I'm leaving to our advisors and the client profiles to decide whether you want to put money. But you'll see a lot of funds coming there.
Sounding very exciting. So final question, then you mentioned FOMO. On that, I'll ask my last question. Through the means of this conversation, if anyone's listening to you, any investor, what would you want to tell them? What should they do to try and, enhance their wealth? And what should they stop doing or totally avoid doing? Actions which lead to investors destroying their own wealth. What would your advice be?
I said, come to a reality that you are not a saver if you are in the markets. Okay, mutual fund is just a vehicle. We invest in the capital market. So we remain long term. Invest long term. I think you'll have noises. Markets are not linear. That's why you make money. If markets are linear, you'll never make market money, right? So in that sense, I think you need to have patience in the market. There is no other way to make money and keep your asset allocation right. I always tell people that have your financial planning done and do allocation right.
Asset allocation is when gold is touching almost $6,000 and everybody's going into a gold ETF.
Yeah, that's a FOMO.
That's what we've seen in India, right?
I always said to people, recently we had a batch of management trainees coming in. I said, if you try to become financially independent much earlier in the career, you can take much more bolder decisions in your life.
Yeah, yeah.
I think I always talk about that, which we never did in our career.
True. Become financially independent.
Yeah.
And then take better and bolder investing decisions.
Investing decisions,
Okay.
all types of decisions you can take if you are financially independent.
Final question then. So when Gop is not in this office thinking about the transition from, Mumbai and Bombay and beyond, what else? What else keeps you busy post office?
Post office, yeah, I do some running,
Okay.
fitness,
Okay.
weekend some golf.
Oh,
I do some. I'm pretty active. At
active.
weekends. Yeah.
You're an active gentleman.
Do some running.
Okay.
I've got a running
Okay.
buddy. I run with him. He's
All
my
right.
golf buddy.
Okay.
Golf and all I recently took it. It's not serious
Nice.
sports at all. But
Nice.
Sundays
nice,
you need
nice.
to be at home. And actually, golf is a very bad for your personal relationship. Because
I think that is a advice beyond investing that Gop is leaving
because
us
there is
with.
around 4-5 hours you spend and
Yeah.
and you had been and I travel a lot across.
Yeah.
We also have an offshore business, so we travel across
True.
the country.
True.
And across
Yeah.
few specific cities globally.
Okay.
So that's what keeps me busy.
Active, busy, running and swinging. Well, fantastic, Gop. What
Well,
a
thank you,
pleasure to
Shreya,
be
for
here
having
in
me,
your
and
office today. And
Every time when I come,
thank you so much.
It's a very good conversation. we have.
It's a fantastic conversation, and I hope to sort of see you, and I'll keep tracking the Access journey on the pillars that you just described, and I'm sure it's going to be a very, very interesting and promising one.
Thank you so much. Thank you so much. Thank you.
Thank you. Well, with that, we are going to call it a day, and it's been a great conversation as always. Axis Mutual Fund, now you know more about their investing style, their processes, and really what their eye is on as we look at least the next 3 to 5 years. So it's a goodbye from the entire team that helps us put this show together. See you soon with another conversation.